Welcome to StockOdds, Odds and End podcast. This is Dave and Rob getting ready for the week ahead. Good evening, Rob.
Here we are on another Sunday night, but we're rocking and rolling. So let's take it away. We don't have too long of a one today, but hopefully it provides some insights. We've got the SPY daily here on this slide. I just want to point out again a fallacy that often happens with traders. They think that because something has risen, that it has to come back down again. And this pattern of distance traveled seems to constantly get in, because I'll tell you, I ran into a lot of people after this sort of move up here already were thinking it was supposed to roll down, this way. And then after we had this gap, well, it's got to roll over and fill the gap. And we continued to grind up, right? And you and I think we're basically suggesting just allow it to breathe and to go and test, the high for the year and then see what happens there. Well, and we did test it and we actually broke through it a little bit even before we had the FOMC announcement, right? So, it's prudent to not think in terms of high minus low, but to think in terms of slope and volatility. And one of the key components that we addressed was the lower volatility displayed in the VIX and the declining volatility that was present and the projections that it would probably continue to go that way, or most likely continue to go that way. So that's what you and I were leaning on heavily to suggest the market still had upside potential. I think this is really important because traders have historically made money from volatility. And when volatility declines, they have a harder time and they take more chances or more gambles or try to make something happen. And I just want to warn against that. Let volatility occur naturally through some event or whatever. And then, of course, you can jump all over it and respond to that increase, but don't get frustrated when it declines and you're not getting those repeated chances to make money. You're not getting that mean reversion that you're looking for. You're not getting those you massive reversals intraday, whatever. That's what the market's giving you. That's what you have to go with. Okay. So I'm still coming through loud and clear.
Yeah, you're good.
Okay. So let's see, we'll go to the next slide here. This is the Qs, and they had already broken through much earlier. In November, we already had a break of the year, and then we pulled back slightly and popped up higher. So there's been a lot of strength in the NASDAQ 100 this year, of course. Then you have the Dow. This one surprises me because, we don't pay all that much attention to it compared to what we do with the NASDAQ or the SPY. But look at how it's, been constantly grinding with high signal, low noise, which shows that there is inflows into the industrials, right, into the blue chips. And that spiked even on Wednesday a lot more as well. So this has been exceptionally strong. But remember, it was lagging for a good part of the year until, it kind of took off here in November and December. And then there was the Russell, which I made a little longer chart going back into December of last year because I wanted to show how we had that earlier spike, really had an incredible January and into February for the Russell, along with, the NASDAQ 100 was doing pretty amazing and the Dow was lagging. But then it really dropped and pulled back because of the regional banking crisis. We just have a lot of regional bank exposure in the Russell. So it really got hurt there. And it traded sideways for a while and recovered, got right back up to test that again. And here we are again. Look at where we're sitting, right back up. And so it also, along with the Dow, had a really good move coming from the oversold conditions at the end of October and getting into having that beautiful seasonality in November, which these are the best 6 months of the year, is November first right until the end of April. And that probably would have stayed elevated up here last year or earlier this year if we didn't have the regional banking crisis. The difference between this and the Dow was that it's been, more syncopated or choppy or more volatile along the way, and then it's natural for small caps to do that. They really had an incredible day on Wednesday, followed through on Thursday, and this is because of this, growth aspect that can come from lower interest rates. So really responding nicely to that. So risk assets have responded and will responded with the prospects of, rates declining next year. And I don't know if the Fed can pull it off the way that it's been telegraphed. If it can be that expectations realized, I don't know. I mean, we're going to find out. So we have no guarantees, but at this point, you can see the response of these indices, and the small caps certainly don't want to be left behind. And if they've been lagging for the year, they want to kind of jump and catch up too. Now, here's the sector performances for Friday and for the week. Friday, we saw technology still holding up. It was expiration. It was, went kind of as expected. It's supposed to be slightly, softer to sideways, and we kind of saw this S&P 500 unchanged for Friday. The Dow and NASDAQ were up slightly, and the Russell was down slightly. But the technology still kind of held up, consumer cyclical. But for the week, really the standouts were the real estate, which is directly related to this interest rate potential decline, at least not being raised anymore and expected to decline. Basic materials rallied well because of the decline of the US dollar. So the logic here is obviously if rates are going to stay elevated for longer, the dollar could stay stronger. If rates were going to go up, the dollar could rise. If rates are going to go down, the dollar should decline. And that's what it did this week and why it popped up the basic materials. Industrials had a pretty good week. We saw that with the Dow Jones movement too. Down at the bottom, it was utilities, even though they had a good response on Wednesday with the Fed announcement, because utilities have a bond component. And so if rates are moving down, utilities usually do better. But for the week, they just got, they had a reasonable week, but they got blown away by everything else. And then communication services had a bad week, even though it didn't do too bad on Friday. But and really that was the Google and the Meta impact there more so than anything. So here's the sectors for the week. Now, we talked last Sunday about the declining relative volumes. And this was kind of this ahead of the FOMC, the wait and see and stuff like that. And also the market was a bit, sketchy in terms of like we had a big run already and people were kind of anticipating a bit of pullback, didn't want to commit too much. But you can see the relative volumes did jump this week. So really the Fed catalyst spurred everything on Wednesday, carried into Thursday and Friday, and Friday was expiration. So you have a lot of back and forth stuff going on. But these relative volumes really did peak up a lot. So perk up a lot, okay? Again, for the week, we see the Russell coming in top place of the market ETFs, followed by the Qs and the Diamonds, and then the SPY finally in the last place. As far as the sector ETFs, we see the real estate in top spot, followed by basic materials, XLI, XLY, and so on. In last place, looks like communications and utilities here. Okay. Map of the market for the week. Oracle had earnings. It did try to recover a bit off of those earnings, but still was down even more than that, more than 9% at one point. So still having a struggle. Adobe, I don't know. So they have a lot of great products, but also struggled this week too. Um, just not feeling the love. But the chips were definitely feeling the love. Avco, Broadcom there was doing really well. AMD, Nvidia, it almost seems to me that they've been leaning a little bit, kind of like what they've done with Apple for many years. Is you sort of lean on Apple and buy other things. It's like leaning on Nvidia and buying other things. Um, leaning, I mean, either repositioning, selling, and repositioning, or shorting and buying the other one. So you're hedged, but so it still moved up for the week, but not as aggressively as we've seen in the past between sort of May and the end of the summer there. Well, actually, May and the end of November, really. It had a phenomenal November. So, um, okay. And then when we got Google, as I said, was having a bad week. Verizon, AT&T as well. So some of the healthcare, again, more defensive. So you can see defensive healthcare, utilities, all, kind of not the things that you really want to go after when the Fed says, you know, money for nothing, right? Let's go. So you want to buy a growth aspect, growth stuff, and home builders because of the declining rates, capital markets, all this stuff's going to benefit. Okay, except insurance. Look at the insurers here, not having a good week at all. All right, moving on. Here's Bitcoin with the US dollar. Now, we still use Bitcoin as a proxy for appetite for risk. We did see it kind of having a little bit of a move up into the FOMC announcement there. This last one here includes what's happening today, pulling back a little bit. So it did get a little bit of a boost, but it's kind of rolled over a little bit. And we just couldn't get through that 45,000 mark. So it's sandwiched between 40 and 45. Don't know any prospects for it. Doesn't have that intrinsic value. So again, it has more speculative value. We've got the US dollar here, directly related to rates. And as the bonds rallied and yields pulled back, we had the decline of the dollar. So that does impact the sectors. Various sectors are impacted more than others, and you do need to use that as one of your leading indicators and understand what it affects the most. So when we go to basic materials, there's quite a broad section of components in it, but the one that it affects the most, of course, is the metals. And I saw a huge rally on palladium too last week from this. So normally, gold and silver and copper might be the more commonly tracked, but palladium had a real big spike. 10-year note, here's the move that we've had since middle of October, when we started to get inklings of maybe either one and done, meaning one interest rate hike more and then nothing, or we also got more narrative of no more hikes, and then we got maybe some factoring in of, hey, there might be a cut in May, and then we started to get maybe there'll be cut in April, and then finally we have, of course, the Fed announcement here, and that really shoots up the bonds, and of course the yields came down, and that was because they telegraphed that, and it's hard to walk that back. They telegraphed that the dovish nature of that they've been accomplishing good things so far, and all conditions considered, we can probably ease in the new year. Okay, so there's as many as potentially 4 cuts, and maybe again we have none. We don't know. We have no guarantees. All right, but this is what the market, how it responded. It loves the idea of rates going back down. Okay, crude. Crude bounced a little bit here, and we had a support level it kind of drifted down to before that. So we still think about that, working off that. Extremely hard to call oil, directionally one day to a next. It seems to have a whole bunch of bad days and also surprise you and have a good day. So I wouldn't say this is one of the easiest areas to trade, the components. We don't actually include energy in our risk on or risk off lists. We do have it in the neutral, and we do have one long from the energy sector and one short from the energy sector. Now, last week we did talk about solar stocks doing really well this week because of our seasonality, right, Dave?
Yeah.
You brought up TAN and some of the other solar, and we had a good week for solar. They really delivered. So that was good.
Mhm.
VIX, here's the decline that we've spoken about many times over, and expecting it to go down to, if there's no catalysts that interfere with this, by April, I would say, or April or May, we should be down around 8 on the VIX. There has to be a catalyst that interferes, otherwise we're heading that direction. Sorry, people. Don't want to be a bearer of bad news, but that is the trajectory we're on. We've broken all levels, and we are, we're having the tailwinds of AI, which just means, information gets more singular. So you're going to need an upset. You're going to need some type of a reset, something that happened to then shoot this thing up. Now, if you're thinking, well, it's getting so low, I'm just going to buy the VXX, which is a tracking stock for the VIX, and I'm just going to sit on that. Don't forget that it decays and decays and decays and decays. So you're going to lose money sitting on it while you wait for the potential event. I think there's a better way to do it. I think avoid that. Just use it as a leading indicator. Trade your equities, trade the sectors, whatever. And if we get a spike back up, the better thing is, if you want to be involved in it, is let it have its event. And when the event is sort of like getting factored in, then you short it, and then you get the decay plus the movement back down. Okay, so a much different game to sit on it expecting something to happen, which you never know when, versus letting the market go first, having a spike, then shorting it, letting it decay for you. Gold, there it is. We had that huge spike up to 2150, and we pulled back to 2000, back up a little bit. And so it's, it's still, relatively elevated overall compared to maybe other things. So it hasn't had a bad year for something that's sort of despised, and not necessarily the big deal it was 20 or 30 years ago. But anyway, it's still sitting up there. And here's the economic calendar, Dave. You can take that away.
Yeah, a lot of housing data this week. Monday, home builder confidence. Tuesday, housing starts and building permits. Wednesday, existing home sales. And then Friday, it's just a lot of housing data. Thursday, we have some U.S. leading economic indicators and GDP report. And Friday, there's a core PCE. That's a good number to show us how inflation is continuing to come down, and new home sales. So it's mostly a housing story throughout the week, and some inflation data on Friday.
And just remember that at 8:30, an hour before the market open, all of these things come through versus the 10 a.m. for the new home sales and consumer sentiment. So just again, 10 a.m. could be very pivotal. That first half hour is often quite directional after the opening range break, and then 10 a.m. is often a pivotal time anyway. So just always watch the clock and be aware of things like that are being released. Let's look back here. We do have existing home sales on Wednesday, that's 10 a.m., as well as the Thursday U.S. leading economic indicators is also 10 a.m. So, and home builder confidence even on Monday is 10 a.m. So just keep that in mind. That time of day is really important, especially when you have releases like that. Okay. And then we have any earnings this week?
Yeah, two major ones. On Tuesday, we have FedEx, and then Thursday, Nike, but not much else.
So FedEx, UPS, natural pair to stock to look at and to consider with FedEx. So it might be a sympathy trade there. Might be something to. And also FedEx can be used like what's the state of, here we are well into, we've had the Black Friday, we've had now we've got the Christmas season. A lot of stuff's already been shipped out. So how's things going for FedEx can be maybe a little bit of a tell on the economy too, to some degree. Okay. Well, if that's you got anything more?
No, that's it. So
All right, we'll call it short and sweet here today. And thank you guys. Have a good trading week.
good luck.